Investing in AIM stocks in a way to protect an estate from inheritance tax is a complicated process. But when chasing yield, it's important to keep in mind the rules around which stocks do qualify. Chris Boxall joins us now from Fundamental Asset Management. Chris, welcome back.
Hello.
We've spoken in another video interview, which viewers can see on the IG platform, about which stocks qualify and how you see these qualification rules work. So let's take a look now at a new development for you. I think you're moving into this idea about having IHT portfolios built around the idea of high yield stocks. Explain a bit more about what you're doing.
Well, the market, a lot of AIM is priced, a lot of it's priced to perfection. I'm not saying there isn't value there is value. However, in the meantime, there are some really unloved companies that are offering quite attractive dividends. And a few years ago, on the request of certain clients, we tried to run higher yielding AIM portfolios, because a big worry for people moving from main market to AIM is they may relinquish some of their dividend income that they've been enjoying. So we tried to run this, and this was circa 8 years ago, and it was very tough. Our universe consisted of very small companies, very illiquid, very unreliable. We thought we'd look at it again, given the current state of the market and clients' demands, and it looks very, very different. Hence, we thought it would be interesting to put together a portfolio with a focus on yield and compare that to our other one we're running. And it could be an interesting thing to do over the next 12 months.
Absolutely. Let's take a look at the graphic that you've brought along, because we've got 14 names that you put in. You put these portfolios together, and this is the one you put forward for us, as you say, that we can discuss over the period. Explain more about this yield, because I think the highest yielding at, what, 7.8%? I think you're using forecast dividend yield, aren't you?
Yeah.
That sounds quite high. How do you ensure that that's a good quality yield and it's not going to be paying it once off?
I mean, first of all, the key thing, we've put together a basket of stocks, and I would always sort of recommend clients look at a basket. Don't be too stock specific and run that basket of stocks. Don't be focused on any individual ones or two, because you're going to have disappointments here. These stocks are not offering these hopeful dividends there's a reason behind it, in that some of them may fail, some of them may cut their dividends. Hopefully others will perform better than anticipated. And you've got a couple of high yielding stocks there. I think two of them are in the same space, Epwin and Safestyle, windows, doors, extrusions. They're facing quite tough times. Both of them have issued profit warnings. One of them, a big customer, failed. But their balance sheets still look pretty good, especially in the case of Safestyle. So the high yield's there for a reason. But the key thing that we've looked at here, and we've discounted a lot of stocks, a lot of companies, we're looking at free cash flow. There's this great fixation about dividend cover. That's the ability of earnings to cover dividend. Earnings are so ridiculously adjusted nowadays. I mean, it's absurd. You and I can create whatever earnings we like. Adjusted EBITDA. And so we drill down into the historic free cash flow of these businesses, what cash they're generating after normal operating costs and normal levels of capital expenditure. How much is left over to cover their hoped for dividends? And normally you've got all of those listed have got sort of 1 times. A few of them are a bit under that, but that was our key criteria, as to give us reassurance that they'll be able to continue to pay them, which is a good start in our opinion. Okay,
I think this bundle of stocks you put together, I think it's got an average market cap of about 125 million. So we're looking at a nice size.
Yeah, you've got. I mean, that's skewed a bit. There are some biggies in there. There's one at about 500, and there are a couple at about 35. But it means there's reasonable liquidity for a lot of them. That was a key difference. A few years ago, it was diabolical. This high yield thing, you couldn't buy or sell them. It's very, very different. Here, a lot of these stocks you can trade quite easily, with a few exceptions. Okay,
let's kick off. You want to pick out 5 particularly here. K3 Capital Group is your first pick you want to talk about. Market cap 76 million.
Yeah, it's an unusual one in that it's probably the growth play of the group. Well, at the moment it's the growth play. It's a business sales company addressing the selling of businesses between circa 50,000 and 50 million. It's a big range. Hasn't been on the market long. It's got still founders involved, founder shareholders, albeit they've sold down, but subsequently a bit controversially, well within the sort of agreed lock-in period. But that was on the back of investor demand. Very high margins, very 35%, terrific cash generator, little need for capital investment. It's based up in, I think, Bolton. It's got its nice premises, very, very slick sales process, very dynamic, entrepreneurial, growing like a train in a nice supportive economy, and it's giving out a big dividend from its excess cash. Because it generates a lot of cash.
So this potentially has growth as well as...
Yeah, I mean, it's been done very well. I think it's close to doubling on its IPO price in quick time. You wonder how much further it's going to go.
Let's bring up the share price chart. We can take a look in more detail. As you say, it's not been listed very long. So here we are now at 187. I think the first candle here was around about £1. So
I think it listed just sub that. It was about 85.
Was it? So it's gained £1.
Nice story, impressive management, very focused, and it could start to be sort of gaining business from the big boys, the incumbents and the big accounting groups and things, because of its more dynamic approach. Very, very really impressed with their presentation, how they go about the sales process of selling businesses. Very, very impressive. It's whether clearly if the economy tanks, that kind of sectors, that's going to really tail off. Yeah. So in the meantime, if they can distribute out as much as possible, shareholders should be very happy.
Pick two, if we can bring up the list of shares again, Manx Telecom.
This is at the other end of the scale. Listed a few years ago and hasn't really made much progress, but it's got a virtual monopoly on the Isle of Man in fixed line broadband, carries quite a bit of debt, but given the reliability of its cash flow, that's easily supported. It's tried to, and it chucks out a big old dividend, which is covered by free cash flow. Yeah. It's had a few hiccups. This is one of these things, if you look through the real earnings and the adjusted earnings, you get a totally different number. Yeah. So stick to the cash flow, free cash flow, try and gauge the ability to keep paying. It's tried to get into other areas. From this nice monopoly position, this big cash generation, it's tried to invest in other ways, data centres, and that's not quite taken off. I think they lost some customers. Quite frankly, being really harsh, it could do with maybe a management shake-up. Maybe I'm being a bit harsh there, but in the meantime, hopefully it's quite reliable.
Yeah, let's look at the share price. Well off the highs. I think we've got a high print here, or it was May 2016 of 223 pence. Here we are now at 184.
It lacks a bit of dynamism. I think you just think it could do a lot better given its monopoly position and given that cash flow. I'm sure it's not as simple as all that, but...
And of course, the dividend proportionately to the share price will rise, wasn't it? So shares come down, the dividends
absolutely, will go up. So your yield's going to go, and the dividend's risen, the given itself has been lifted marginally, but it really hasn't, in terms of top line and real operating profit, it hasn't really progressed much since listing, so it hasn't really gone.
But you're confident the dividends will continue?
Look, I'm confident the dividends are going to continue on that one, yeah. It is a pure dividend play at the moment. I just like it to turn into a bit of a growth play as well, use the market for what it's there. There's no point being listed just to...
Well, this is one of the things about AIM, isn't it? You're hoping for growth as well.
Absolutely.
Stock number 3 is Shoezone. Going back to the list, this is a market cap 83 million, and Shoezone, their 6.1% historical dividend, 6.3% ahead.
Yeah, that's... The fear with Shoezone, they've just announced results were down on the prior year. It's a tough old marketplace selling.
It's a retailer. That says it all, really.
Absolutely. It's got about 500 shops. It's moving from small shops to what they call big box format. It's trying to grow on the internet, but it's a tough old space. It does very well managed. Not the founders, but their family. Smith family own about 50% of the equity. They like their dividend. It previously paid out a special. My fear was, before the recent results, that it may not even be able to maintain the final, let alone a special. Right. But it's clung on. We haven't got a special dividend. It's producing lots of cash. It's got net cash, about £11 million. And it's a very well managed business. We think it can keep going now. As I say, we had worries.
Yeah, absolutely. If you look at the share price, back on the 21st of April 2015, massive gap opened up on a profit warning. This is the problem, isn't it? When you get a profit warning to a relatively small company like this, it does affect it.
Absolutely. Was market cap about 80 million, turns over about 150, 9 million, I think, pre-tax. So it's got, the cash buffer is always reassuring as well, and that long-term, family insider ownership. Which hopefully reassures as well.
Yeah. Let's get to NAHL. This is National Accident Helpline.
Yeah, National Accident Group is what the core business is. National Accident Helpline, which I think represents about 60%. This is introducing clients, those people that have been subject to accidents and injuries, to a panel of lawyers, and for that they get an introductory fee. They've got a residential related intro business again introducing, it's a marketing play to legal firms. Now they've been really hit because of Ministry of Justice review that's going to restrict the whiplash claims. So that's really hit their business and meant they've got to change their business model. And that will see them investing in a joint venture vehicle. It's already started with some of the law firms. They've got an arrangement with a division of one of the other companies we listed here, actually, New Law. And their dividend, their cash flow is not going to be as rosy going forward as it was historically, because there's going to be a cash drag as it takes longer for these claims to progress. However, even with the reduced level of dividend, it should be adequately covered by cash flow now, and the yield is very, very attractive. And should the Ministry of Justice, the impact of that be not as great as feared, that share could recover quite strongly. It has already staged a bit of recovery, and you're still getting 6% old yield. It's not without risk. I've referred to before a sort of sword of Damocles hanging over it with this MOJ review, and who knows what will happen. But and it is very reliant on National Accident Helpline. I noticed two of the other lines of business are not doing as well. But the
so you see upside for the share price on this?
Well, I do. You see where it's come from. Yeah. I mean, everybody loved it at one point after it listed. Yeah. It's just had to get a bit cannier and a bit cleverer.
And the uplift recently has been some 50-odd%. So
yeah, I mean, it's already come up, but you can see it could go a lot more. You've got it's telling you, the yield is telling you, free cash flow should be good. If that yield, you're paid for being patient. You can sit there in the hope that it'll recover a bit more.
Okay, the final one is Elegant Hotel Group. I think you were telling me that just before we went to air, this is the only overseas company in this list? Yeah,
this is the only one really, and with that, with this business, you're subjected to geographical risk, foreign exchange, foreign currency risk. It's a business that owns 7 hotels and restaurants on Barbados, and it's the dominant hotel owner on Barbados, and so it's got a decent book of properties which underpin it. I question the value assigned to those properties. I mean, how do you can get an independent valuer to really assess? And people witter on about the asset backing. Well, the asset backing in any business is only so good as the cash you're getting off it. And this business seems to need to reinvest quite a lot of its cash in upgrading its properties to attract them to people that are paying a lot of money. And that's always going to be an issue. And it announced relatively recently, and it said, look, we've got to hold back some of the cash previously sort of allocated to the dividend to capital investment, and as a result the forward yield has dropped a bit to 4% and a bit, but that's acceptable. But I think it's a very interesting example that asset backing really is only so good as the cash that asset's producing, and these assets, if you have travel problems, their revenue generating ability could be severely cut. But it looks in an interesting position. It's got a big dominant shareholder in someone that knows the leisure sector pretty well. And again, if the outlook, if the foreign currency is more stable going forward, or if the pound strengthens miraculously, they could be a big beneficiary. And people and shareholders do very nicely.
Just to wrap up, we must go back to this point about the fact this is a portfolio, and you are obviously, there's some risk here with some of these individual stocks, but of course, broadly speaking, you're looking for some healthy returns. So looking good for 2018?
Yeah, we think despite overvaluation in areas, there are pockets of good value. We have the Carillion issue that's overhanging things, but generally speaking, I think people are going to have to work hard. Investors are going to have to work a lot harder. Maybe think they're going to take up a bit more risk. Maybe look at some of these unloved, boring, or so we say, the plodders of AIM, which could be a good thing. Yeah. Okay, Chris. All right. Thanks so much indeed for joining us, and we look forward to our next update with these high-yield stocks on AIM and those that are IHT efficient. That was Chris Boxall from Fundamental Asset Management. Subscribe to IG for educational content, company insight, financial analysis, and expert commentary.